The concept of tawarruk. There are times when you're faced with a genuine need for cash. While you can buy a car through a murabaha transaction or lease a house through ijara, what would you do when all that you want is just cash? Tawarruk, or commodity murabaha, is a Sharia-compliant financing solution designed to help you with the liquidity you want. Let us look at one such example. Ayub is a sales executive with a company in a bustling Middle East city. These days, Ayub is very excited. He is getting married in 2 months. Excited as he is, Ayub is a little worried too. Well, we can't blame him for that, can we? Is it the stress of work? Aha, that's enough reason to worry about. Looks like Ayub is in trouble. His projected expenses for the wedding are way above his savings by 63,000 dirhams. Ayub decides that it is time he consulted Mr. Omar, the CSO of the Islamic Bank, about his predicament. Maybe Mr. Omar will have a solution. So what can I do for you, Mr. Ayub? Mr. Omar, I'm getting married shortly, and I think I might have to borrow some cash from the bank to help me meet the marriage expenses. Yes, of course. How much money do you think you may need to borrow from us? About 70,000 dirhams? Shouldn't be a problem. We will be able to give you this money through a tawarruk deal. Tawarruk? Could you please explain to me how this works? Yes, of course. How does tawarruk work? You know, Allah has permitted trading and prohibited riba. Thus, if you want an asset like a car or a television, I can sell them to you on credit. But here, your need is for financial liquidity, cash. So, the objective will be to raise cash by trading. That is, if you had something to sell, I would have bought it from you in cash, and thus your need for cash would have been met. But again, you do not have anything to sell, do you? No, I don't. Let's look at a hypothetical situation. Now, you want cash of 70,000 dirhams to help you meet your marriage-related expenses. Let's say you have 2 friends, A and B. Well, that's pretty simple. I'll buy the car from A on credit. I will pay you 70,000 dirhams later in installments. Okay. This is a murabaha transaction. And sell the car to B for 68,000 dirhams in cash. Yes, now you have the funds that you wanted. All you did was to trade, and so the transaction is in compliance with Sharia. You will have to bear some loss, but you will also have benefited by getting the money for your immediate use, which can be repaid in future. Tawarruk raises liquidity by way of permissible trading. It sounds so easy. Is this how tawarruk works? Yes, that was indeed a tawarruk transaction, but there are some rules that you will have to follow. Rules for a valid tawarruk. Rule number 1. sale and repurchase is not permitted by Sharia. Let us look at our earlier transaction in a different way. You buy the car from A on credit. Then, instead of selling it to B, you sell the car back to A for cash. This is a case of sale and repurchase which is not permitted by Sharia. The correct transaction will be, you buy the car from A on credit and then sell it to B on cash payment. Rule number 2. There must not have been a prior arrangement between the three parties. Rule number 3. There must be an interval between each purchase and its subsequent sale. This is to expose the parties to price risk. Gains from the transaction should be a reward for risk borne. For Sharia compliance, it is necessary that actual purchase and sale should take place along with transfer of ownership and related risks. So as I said, I need about 70,000 dirhams. How do we go about it? The process of tawarruk. Let's take the earlier hypothetical example where you bought a car from your friend A on murabaha basis and sold it to your friend B for cash. What was the result of the transaction? On the one hand, I ended up with liquid funds, and on the other, I could pay the purchase price of the car in installments. Correct. But it's not always that you will have a friend who sells a commodity for credit and another friend who buys the same commodity from you by paying cash. Yes, I agree. That was a hypothetical situation. So, what really happens in a tawarruk transaction? Let me explain. Now, you would like to borrow 70,000 dirhams from the bank. The Islamic bank will buy a commodity, usually a metal like copper, from a trader at the London Metal Exchange for 70,000 dirhams on spot payment. Please note that it cannot be gold or silver, as the same are equivalent to money, which cannot be sold in this way. The bank will now sell this metal to you for 77,000 dirhams on a cost plus profit or murabaha basis. That is, cost price 70,000 dirhams plus disclosed profit of 7,000 dirhams. You are now indebted to the bank for 77,000 dirhams, which you will promise to repay in monthly installments over, say, 4 years. But you still haven't got the funds yet, have you? No, but now I own 70,000 dirhams worth of copper, and that's something I do not want. So I presume that I'll have to sell the copper to get the funds that I wanted. Yes, but we will do that for you. There will be an agency agreement between you and the bank. The bank, acting as an agent, will sell your copper to another trader at the London Metal Exchange for 70,000 dirhams on spot settlement. The cash proceeds from the sale will be credited to your account. So we have traded in metal. I have the liquidity that I wanted. You have your profit from the trade, and there was no instance of riba. Well said. Let's summarize these transactions. The bank buys copper from the LME trader A for 70,000 dirhams. The bank sells copper to Ayub for 77,000 dirhams. That's cost plus profit sale, which is murabaha. Ayub will pay the bank 77,000 dirhams in 48 installments. Ayub then sells copper to the LME trader B, the bank acting as Ayub's agent, for cash, 70,000 dirhams. And cash from the sale proceeds is credited to Ayub's account. While in transaction 3, the customer obtains the funds that he required. In transaction 2, the sale price deferred by the bank enables the customer to pay back the financing facility to the bank within an agreed term. Some banks use the principle of tawarruk in covered cards, don't they? I'll explain that concept. Tawarruk is an Islamic financing method used to provide customers with liquidity. Tawarruk is a means of generating cash by way of trading. The commodity is being traded only for the purpose of raising funds and not as an end in itself. It combines two separate sale and purchase transactions. There are 3 important rules to be followed to ensure that the tawarruk transaction is valid. Rule number 1. The commodity must be sold to a different person and not to the seller himself. Otherwise, it will be a case of sale and repurchase. There must not be a prior arrangement between the parties to a tawarruk transaction. Rule number 3. There must be a time period between each purchase and the subsequent sale. Tawarruk is also the basis for the issue of Islamic covered cards. Some scholars have reservations against tawarruk based on the fact that tawarruk creates new debts far larger than the cash received. You may now reinforce your learning by going through this topic in the illustrated textbook and check your comprehension of the subject by attempting the questions in the workbook. Our next module will introduce you to the concept of musharaka. The concept of musharaka. Musharaka is a preferable technique for financing by Islamic banks for any manufacturing, trading or business venture where the bank is willing to act as a partner. Let's have the pleasure of meeting Dr. Rashid once again. He had opened a clinic 5 years back with financial assistance from an Islamic bank. Now, he wants to expand the clinic into a multi-specialty one with one of his friends, Dr. Nazir. The doctors need extra funds for the project, and they decide to approach an Islamic bank. At the Islamic bank, the doctors explain their requirement to me, their friendly customer care official.
Dr. Nazir and I plan to expand the clinic into a multi-specialty one. We were wondering if you have a suitable financial product for our project. This time, we would also like to invest some of our own money in the business.
I think musharaka will be the perfect financial arrangement for you.
Would you mind explaining musharaka in detail?
That's what we are here for, Doctor. In Islamic finance, the word shirka means partnership. There are 2 types of shirka: partnership of ownership and contractual partnership. Shirka al-Milk is a partnership that arises automatically due to joint inheritance or gift. It can also be a partnership that arises by choice. Shirka al-Aqd is a partnership where the parties concerned willingly enter a contract for joint investment and the sharing of profits and risks. This is generally used for partnership businesses by Islamic banks. The financial facility you need now is called musharaka and belongs to Shirka al-Aqd. The steps undertaken in a musharaka. In musharaka, 2 or more persons provide finance for a project. All partners have a right to work for the joint business. However, this is not a necessary condition. Any of the partners can be a sleeping partner, authorizing the others to manage the business. All partners are entitled to share the profit in a pre-agreed ratio. The losses, if any, are to be shared exactly in the proportion of capital invested by each partner. Musharaka is useful in financing of manufacturing, trading, or any business venture where the bank is willing to act as a partner. The basic differences between a Mudaraba and a Musharaka.
What are the differences between Mudaraba and Musharaka?
The differences between Mudaraba and Musharaka. In Mudaraba, the capital is put in wholly by one party, whereas in Musharaka, all the partners are investors. In Mudaraba, the capital investor cannot take part in the day-to-day management of the business, but in Musharaka, all the partners have the right to take part in running the business. In Mudaraba, the losses are borne entirely by the capital contributor, but in Musharaka, losses are borne by all the partners. In Mudaraba, liability is limited to the capital invested, and in Musharaka, liabilities are usually unlimited. In Mudaraba, in some cases, Mudaraba assets may belong only to the financier, only the income might be shared. But in a Musharaka transaction, all assets are joint property of the partners on pro rata basis.
I think the Musharaka contract will be perfect for our requirements. We will discuss this further and get back to you in a day or two. Thanks for the valuable information.
You're welcome. What we have learnt in this module. The financing technique of Musharaka. A Musharaka is a partnership where two or more financiers provide finance for a project. All partners are entitled to a share in the profits resulting from the project in a ratio which is mutually agreed upon. If there are any losses, however, these are to be shared exactly in proportion of capital invested by each partner. This form of financing is useful for any manufacturing, trading, and other business ventures where the bank is willing to act as a partner. Diminishing Musharaka has been used mostly in house financing. Musharaka is also known as joint venture facility or partnership financing. The accounting procedures in a Musharaka and all about projected profit margins to be paid every month, which will be adjusted at the end of each financial year. There are three main forms of Musharaka: permanent Musharaka, temporary Musharaka, and diminishing Musharaka. We learnt the main differences between these three types. How each of the types of Musharaka gets terminated. The main differences between a Mudaraba and a Musharaka. You may now reinforce your learning by going through this topic in the illustrated textbook and check your comprehension of the subject by attempting the questions in the workbook. Financial calculations and profit sharing in a Musharaka.
Can we do Musharaka using an equal share of capital to keep calculations simple?
For example, we are calculating the total investment here as 5 million dirhams. Now, if the two of us put together 2.5 million dirhams, can the bank pitch in with another 2.5 million dirhams?
Yes, we can invest in any ratio as may be deemed fit. As you have suggested, both parties can provide 2.5 million dirhams each as investment. So here, the bank will provide 2.5 million dirhams and both of you together will provide 2.5 million dirhams as an investment. All expenses will be charged to the business and all assets will belong to both parties. Profit is shared in the pre-agreed ratio. Loss is shared in exact proportion of the investment. This is the basic principle of shirka. In our case, it has to be 50-50. Profit ratio will be decided in the beginning, assuming it's 40-60, and let us suppose the profit is 10,000 dirhams. The bank will get 4,000 dirhams and the doctors will get 6,000 dirhams.
If the profit is calculated annually, the bank will get the profit only at the end of each financial year, isn't it?
This arrangement may not suit both of us. Let me explain with an example. You, as a client or partner, will be required to give the bank a report outlining the projected profit margins while entering into the contract. Assuming a sharing ratio of 40:60, the client has to give us a projected profit at the rate of, say, 12% per annum on our share of investment every month or quarter. At the end of each year, all the asset values, revenues, and expenses will be collated, and the actual profit margins will be calculated. This is called constructive liquidation of the joint venture that is needed for calculation of the profit while the business is still going on. After constructive liquidation, if the bank's profit share is greater than 12%, the difference is paid to the bank. And if the bank's profit share is less than 12%, the bank shall refund the difference. This difference can be adjusted in the following year.
We firmly hope that the profit might be even more, say in the range of 25 to 30%.
In that case, we may consider giving you a good management bonus. After a certain range, the sharing ratio can also be changed in your favor. Maybe it can be 70% for you and 30% for the bank. Such good management bonuses will also be mutually agreed upon in advance and set down in the contract. A bank representative will be on the management board. He has the right to check the accounts and review the managerial aspects at his discretion.
Well, that will not be a problem at all.
Is there any limit to the number of partners in a musharaka?
No, there is no limitation laid down in the rules. To make it less complicated, I would suggest that you both enter into a partnership between yourselves. Hence, the partnership will be between Rashid and Company on one side and the Islamic Bank on the other side. Therefore, the contract will be drawn up between Dr. Rashid and Company and the Islamic Bank.
What will be the duration of the contract? We are thinking of a period of, say, 5 years.
With respect to period or tenure, there are mainly 3 types of musharaka contracts.